All right, let's continue the topic in Chapter 22. We started off from understanding just the components of master budgeting. So remember, this chapter, what we're trying to do is not the actual statements, because remember you learned that in financial accounting already. What we're trying to do in this chapter is to put together a set of expected numbers. So different departments, the department heads will work together as a team to put together the budgeting that relates to income statement components, that relates to balance sheet components, and also statement of cash flows. Okay, so what we're trying to do here is to anticipate in the future seasons what is the potential sales revenue that we're collecting from customers, what is the potential cost of goods sold amount, for example, and what's the potential expenses. And we break it down into variable expenses, fixed expenses, as we covered in previous chapters. And then at the end, in the operating budget section, we want to get to is the combined first three boxes, which will give us the budgeted income statement. Okay, so the whole set, the upper part here in this graph, essentially is the same thing what I wrote on the whiteboard here, is leading to the budgeted income statement, but specifically breaks down to three components. Okay, so let me just go through these really quick, and we're going to do an exercise. We actually covered this before midterm last class. So remember, the first component of operating budget starts with sales budget. So what sales budget is trying to do is to calculate future seasons' potential sales revenue. So this, we break it down in this chapter. This example gives us 4 months of detailed sales revenue, and also breaks it down into cash sales and accounts receivable sales. Okay, so they expect that in April, for example, $50,000 of sales revenue. We're not actually collecting them by cash, the whole set of these, but only 60% of it. So $30,000 we'll be actually collecting by cash, and then the $20,000 will be deferred to later month. Okay, same for May. We're only collecting 60% of this, 40% defers to next month. So same goes on and on for each and every month. So from this entire table, what we need to input into income statement at the end is this $240,000. Okay, the $240,000 is the total sales revenue that at the end becomes the first line of budgeted income statements. All right, so this is sales budget. Our goal is to get to this line over here, a summary of all 4 months set of sales revenue. Now the second component of operating budget, once we get this second component, remember whenever we make sales transactions at the same time, there's also cost of goods sold affected, there's also inventory level affected, and then we may need to replenish the inventory. Okay, so second budget sets, second components of operating budgets, we will need to complete this table here. First line starts from cost of goods sold. Now remember that since sales transactions has sales revenue affected, cost of goods sold is affected, usually business will set a percentage. Different business may set it differently. This example sets it as 70% of sales will be estimated as the level of cost of goods sold. Okay, so the first month here, April, we need to refer to sales budget $50,000 here times 70% to get April's cost of goods sold value. So notice that each and every transaction, different types of products, the cost of purchasing the product is different. So this is really just a rough estimation of what cost of goods sold can be. Okay, so they estimate it as 70% of sales. We use whatever sales revenue is times 70% to get April's cost of goods sold, to get May's, June's, July's. All of them is 70% of sales. Okay, now second line here, desired ending inventory. They also have a specific policy here. They want to have at least $20,000 worth of inventory, and then also 80% of next month budgeted cost of goods sold. So remember that ending inventory store in places for use of next month's sales transactions. So they budget this as having at least $20,000 worth of inventory, and then whatever the first line's cost of goods sold budget is, 80% of that plus $20,000 becomes ending inventories budgeted level. Okay, so once we have the first two lines, if we add them together, that becomes the total set of inventory that the company needs to have for April, the total set that company needs to have for May, for June, for July. Because a portion of that becomes cost of goods sold out to customer. The remaining portion is left in the warehouse considered as ending inventory. So the third line here really is just a total set of inventory that a company needs to have in the business every single month. So after the third line, how do we interpret the fourth line there? Why do we need to subtract beginning inventory? So we have cost of goods sold estimated, the portion that will be sold out to customer. We have ending inventory estimated, the portion of the inventory that is kept in the business in preparation for future month sales. We add them together, that's the third line, the total set of inventory the company needs to have. Then we mine this beginning inventory for what purpose? It was the previous month's ending inventory, which will give us a number, the portion of the inventory that we need to replenish in order to fulfill the policy here, having at least $20,000 of inventory, having 80% of next month's cost of goods sold. Okay, so once again, the third line, we total up the inventory that the company needs, but then sometimes it's not enough. At this moment, they need $99,800 worth of inventory, but in the beginning of the month, they only have $48,000 of inventory. So which means that this month, they have to make inventory purchase transaction that worth $51,800. Okay, so for each and every month, we estimate the portion of sales that we need to make, and then a part of that, what is the cost of goods sold worth? We estimate the ending inventory, add them together becomes the total set of inventory that company needs to have for every single month. Compare this with previous month inventory that's left over. So the differences becomes the part that we want to replenish. We need to purchase more. We need to purchase more in order to fulfill this, in order to meet the sales that we anticipate to make in next season, in next month. Okay, so this is the second component of operating budget. Sales budget, you want to get the total sales revenue. Operating budget, the second portion here, this table at the end, what transfers to income statement is that $168,000 cost of goods sold. Because income statement, we start from sales. Second line, we have cost of goods sold. This $168,000. After these two, we get a potential gross profit. Subtracting cost of goods sold from sales revenue. Okay, so this table actually, we're only transferring this to income statement. But all the other numbers are still important because we will be using these numbers, the purchases and cash budget. We'll be using inventory and balance sheet. Adjusting income statement, we're just using the blue highlighted number there. Okay, so after this, we have the first line of income statement. We have the second line of income statement. We can get to anticipated gross profit. And the remaining portion of income statement is all related to expenses. Okay, so the second component of operating budgets, this portion here, we're estimating different types of expenses. What's the level of it? So the first two line here, variable expenses, just by its nature, its characteristics, it increases as sales increases. So you can see that commission expense, if the company sets the estimation policy as 15% of sales, the more sales revenue occurs in a month, the more commission will be anticipated in that month. Okay, so you can see that across all 4 months, May has $12,000 worth of commission estimated, which means their sales revenue actually is more than other months. Okay, miscellaneous expense could be delivery expenses, could be part-time workers, hourly wages. That's not in a full-time worker's contract. So the more sales activities happens, the more workers perhaps you need to hire, the part-time ones. Okay, so the second line here is also estimated based on sales revenue. The more sales revenue there is, the more commission expense, the more miscellaneous expenses captured. Okay, so as opposed to that idea of fixed expense here, you can see that each and every month we estimate it at the same level since it's already fixed. As long as the business does not have a significant expansion, then this is not, as long as the fixed expense is not bumped into the second relevant range, then we usually estimate it as the same. Okay, so at the end of this table, what we want to transfer to income statement, again, is the total amount of all 4 months variable expenses, a total amount of all 4 months fixed expenses. So we'll transfer those blue highlighted numbers, combining the first two components with the third table into income statement. So the goal for master budgeting in the first section here is to get to this budgeted income statement, which looks like this. Okay, so the $240,000, we got this from the first table, second line, second table, second component, cost of goods sold inventory. Then the remaining, these expenses, we got it from the third component, which is the operating expenses section. So income statement, basically, we're not breaking it down into 4 months. It provides a summary information of all 4 months data. All right, I'm just briefly going over what we covered last time, in last class. Any questions so far before we move on to exercise? All right, let's see if you have questions when we do the problems. Let's take a look at this problem, which relates to the exercise sheet that I just gave you. What we want to put together first is the first table, sales budget. Okay, sales budget in this problem, it tells you 2 months of expected number of products that they want to sell, and also the expected sales price for 2 months. Okay, so just kind of fill in the table with the information, time them together, find the revenue for January, find the revenue for February, and then total them up, find the aggregated number. We would be using this for second table as well. Doing this exercise now. They see this. I'm sorry? No, it's just an exercise, not a test. No, just do the first table. Okay? You don't have enough information for the second yet. Okay, so for this sales budget table, what we're doing really is just kind of filling in the information because it tells you there's only one type of product in this business. It tells you we expect to sell 8,500 pairs in the first month, and then we expect to sell 3,500 pairs in the second month. Price is also different. First month is 180, second month is 190. So what we need to do is just times these two numbers, find the summary sales revenue, and then add them up, which becomes 2 months of budgeted sales revenue. Okay, so if you times those two numbers, it will give you this. And the 2nd February, $665,000. Total them up. If we want to do budget for the next 2 seasons, this is sales revenues budgeted amount. Okay, we'll be using this number for future tables as well, so keep the numbers. Have you noticed there's difference between this table with the one that I mentioned in the slides earlier? So this sales budget is a relatively elementary sales budget, since it's only using a type of product's price, a type of product's expected volume. It's not giving you a whole set of different products. So remember earlier in the sales budget, the table was broken down into 60% of cash sales, 40% of accounts receivable sales, right? So this one here is a way to form the table of sales budget. This is another way to form sales budget. A company can choose to either one of these. This one gives you more detailed information of what part of the sales you're actually collecting. This one is more elementary. Usually this number is an aggregated, in reality, usually this number is an aggregated of different types of products. Product 1, sales price times product 1's volume plus product 2, sales price times product 2's volume. Add them all together, that will usually become this number. Okay, but this problem is relatively easy. It only tells you there's only one product the company is selling, and this is the budgeted sales revenue for that product. So if the company has multiple ones, then the total sales revenue expected will be a whole summary of all these different products, volume expected, different products, expected sales price. Okay, let's move on to second component of operating budget, inventory purchases, cost of goods sold. Using the same numbers here, but we're adding more information. Okay, so the second table looks like this. We're continuing using the sales that you got from January and February. And we're using a policy 60% of the sales that you got in the previous table is estimated as budgeted cost of goods sold. Okay, second line, ending inventories policy is the company wants to have at least $10,000 worth of inventory, and then adds on to that is half of next month's budgeted cost of goods sold. Now you total that up, subtract last month's ending inventory, which is this month's beginning inventory, to find the level of purchases that you need to make in each and every month. All right, so start from the first line. Get cost of goods sold first from previous sales. Try to figure out ending inventory and complete the table. Very good question. Beginning inventory is December's ending inventory, right? December's ending inventory also follows this policy, which means it's $10,000 plus January's cost of goods sold. Okay, so there you go. So $10,000 plus 0.5 of whatever next month's cost of goods sold is that you got in the first line. For December, then this cost of goods sold for next month basically is referring to January's cost of goods sold, right? Then plus whatever you got in the first box, the January's cost of goods sold. Mm-hmm. Yes. Using December's, but because we have the policy for every month's ending inventory, right? So beginning inventory for January referring to December's ending inventory. Ending inventory of December's would be $10,000 plus 0.5 times January's cost of goods sold. Okay, so if you got January's cost of goods sold, just plug it in this. That basically is beginning inventory for January. Yes, right. But for January's ending inventory, you're actually, yes, you're using February's, and then February's you're using, yes. So February's ending inventory, you actually need to get March's sales revenue first, get March's cost of goods sold in order to get it. Plenty of extra. Okay, first of all, to complete this table, we need to get the first line cost of goods sold for each and every month, which is needed for calculating ending inventory, and later on find the replenishment, the purchases inventory value. So we start from cost of goods sold by using previous tables, sales revenue for January, sales revenue for February, to get to cost of goods sold estimated amount. So if you use this to times 60%, what are you getting for January? $918,000, right? What about February? $399,000. Okay, so this is for the 2 months. We have cost of goods sold 60% of sales. Now for ending inventory, we need to have at least $10,000 worth of inventory, and then we add additional 50% of the next month's budgeted cost of goods sold. So for January, you already have February's cost of goods sold. You use that times 50% of $399,000. This is the process of getting the answer. You should be able to get $209,500, right? Okay, so January is easy. What about February? February, again, you need $10,000 at least, but you need to add March's budgeted cost of goods sold, right? So March's sales revenue, you can actually get it from the additional information on top of the table given to you. It tells you that we're expecting to sell 4,100 pairs. Each pair is sold at $260. So this is the budgeted sales revenue for March that you can get from the previous lines on top of the table. Once you have the sales revenue, same policy applied to March. 60% of sales is cost of goods sold, so you times 60 to get March's cost of goods sold first. Okay, so that should be $639,600. That's the cost of goods sold for March, and this is useful to get February's ending inventory. So you will use $10,000 plus March's cost of goods sold, half of that. Okay, so after this, you should be able to get $329,800. This would be the budgeted ending inventory for February. All right, so if you have the first two lines, the third line, what we're doing is adding up what is the total value of inventory needs to be set in place in the business for each and every month. So you have the portion that you're expecting to sell out to customer. You have the portion that you're expecting to keep for next month's sales, for future sales. Add the two up, you should get the total inventory required, these two values. And then we compare the total inventory that a company needs against what they have in the beginning of the month to find whether or not they need to make new purchases in the business. Okay, so the third line, you total up the two numbers we just figured out. Now when it comes to beginning inventory, this is testing on whether you know beginning inventory is the previous month's ending inventory. Okay, so this $469,000 is a little tricky to get. It breaks down to, basically it comes from last month's ending inventory, December's ending inventory. So if we want to get December's ending inventory, remember the ending inventory policy is $10,000 plus 50% of next month, which is January's cost of goods sold. So we'll be using $918,000 times 50% plus $10,000 to get to $469,000. This is the ending inventory of December, which is also beginning inventory of January. Okay, now beginning inventory for February will just be ending inventory from January. So you already have ending inventory from January, just copy the number to February's beginning inventory. Okay, so if we come back to January again, we're comparing the inventory that we need with the beginning inventory that we had, which again is December's ending inventory. The difference is this value here, $658,500, is the inventory purchases that the company needs to make in January. Okay, so same theory here. We need to have $728,800 of inventory in February, and we had at the end in January $209,500. Compare the two, we need to make additional purchases of inventory that are worth $519,300. Okay, so again, this table would really transfers to income statement. The number that we need at the end in the budgeted income statement is the total number of those two cost of goods sold. Okay, so earlier in the table we actually had additional column, a total column, where you need to pick for income statement with the cost of goods sold part would be $918,000 plus $399, the two budgeted cost of goods sold for this month. Just telling you that this table, those two numbers, the summary of that will be transferred to budgeted income statement. All the other numbers will be used for additional other components in the budget. Will be used for cash and balance sheet later. And this table, really the tricky cells here are the ending inventory for February, which you're getting from March sales revenue, and also this part here, beginning inventory from January, you're getting from December. Okay, so make sure you understand those two numbers, where it comes from. It can't just be used for looking at January and February sales. You actually have to refer to March sales. The other one you need to refer to February's sales, and also January's cost of goods sold. January's beginning inventory, you need to refer to January's itself's cost of goods sold. Okay, question? All right, so this exercise, what we did was the first two components of budgeted income statement, and then of course we also have operating expenses. Then it completes the entire budgeted income statement. And we want to know what is the budgeted net income at the end. Okay, on the next section we're moving on to financial budget. So remember, capital budget is in the middle of those two, but we already talked a lot about long-term assets purchases in the previous chapter, which you also tested on midterm 2. Okay, so we're going to exclude this portion here, assuming that we already know, since you've already been using the 4 tools to analyze long-term assets projects, whether to invest it or not. This chapter will focusing on understanding, learning more about other areas of budgeting, not just long-term assets. Okay, so we're moving on to financial budget. Breaks down to cash budget. At the end, we want to get to budgeted income statement, and then also statement of cash flows budget. Now, just cash budget, actually, it breaks down to 4 additional components. The cash budget, we want to understand the numbers, the expected cash collection from sales, the expected cash payments to pay inventory purchases, and also the expected payment for operating expenses, and the expected payments for capital budgets. Okay, so cash budget, in summary, it's basically the information about cash receipts and cash payments, but in detail, it can be broken down into cash collection, cash payment, specifically purchases, cash payment on operating expenses, cash payment on capital expenditures. Okay, so today we'll be focusing a lot about on this, and if we have time, we're also going to complete this exercise in the back of the 2 tables that you just completed. Then, using this budget summary information, remember, cash is the first account of balance sheet. So we'll be using that summary, transfer it to balance sheet, pull some of the other informations from inventory, for example, also needs to be transferred to balance sheet. Sales budget, the portion that's accounts receivable, also needs to be transferred to balance sheet. Okay, so this part will be completing assets, liability, equity, budgeted information. Statement of cash flows, you might think, how is this different from cash budget? So basically, this isn't more detailed. We break it down to months. Statement of cash flows, we summarize them as one. So just like income statement, the information here breaks down to the first 3 components. Statement of cash flows is capturing a summary information of all 4 months, but not broken into details. So cash budget is a lot more detailed. Statement of cash flow basically is a summary of cash inflow and outflow. Okay, so let's start from cash budgets. Cash budgets, again, breaks down to 4 components. First component we want to know is what's the money that we're collecting from customer? What's the cash inflow that a company is generating based on sales or based on services? Okay, so first table will look like this. We will need to refer to sales budget. You just did in one of the exercises. When we complete cash collection budget, inside the cash budget section, we need to refer to sales budget because remember that's where the money comes in from. Okay? So remember that earlier table we showed you that 60% of them were actually collecting by cash, additional 40% we're deferring to next month, right? So when we do cash budget for each and every month, it's not exactly the $50,000 sales revenue. We're only collecting a part of that. So 60% of cash we're collecting, that's definitely the cash inflow that we're getting. So this portion here transfers to cash collection budget. Now what about the 40%? It's deferred so that $20,000, $32,000, $24,000 becomes next month's cash collection. Okay, so if you just look at April alone, $30,000 comes from this entire month's sales. $16,000 actually is from March. Previous month's 40% that you haven't collected by cash transfers to April. If you look at May, $48,000 is itself this month's sales revenue, 60% of that. This $20,000 come from credit collection, which is the sales transactions you made in the previous month, April. Okay, so that said, the 40% of sales revenue you're not actually collecting in that month, you're deferring the collection to the following month. Okay, and just to make sure you understand, this 16% comes from the previous month. Okay, this comes from April, this comes from May, this comes from July. Okay, so this table here, again, what we're trying to do is just calculate what's the cash inflow that we're actually getting in the business. So it's not accrual sales. All the accounts receivables we're not capturing here. Those accounts receivables becomes actual cash collection in the following month. Okay, so after you put together these information, what we need to do is just add up the total cash we're getting. This part here will be transferred to the ending statement of cash flows at the end. Okay, so this is the first component of cash budgets. We're getting the cash collection part, the inflow of cash. And specifically, we're only listing each and every month's actual cash sales, not the accounts receivables. Accounts receivables transfers to the second month. We're collecting it in the following month. Okay, so after cash collections, we'll be going over the cash payments, and we break it down into specific categories: payments on inventory, payments on operating expenses. Okay, so based on the name, if we want to understand payments on inventory, we need to refer to earlier the table on how much inventory we actually purchased. So remember operating budget, the second component, we understand the purchases level based on the expected cost of goods sold, based on the expected ending inventory. So here, let's say the company assumes that of all the accounts payable transactions, they're only paying in actual cash this month only 15% of it. So remember accounts payable, company usually when they do large purchases, they rarely directly pay the full amount in cash. Usually a portion of it defers to following month. Okay, so assuming this company estimates that about half of their inventory, the accounts payable, they're paying by cash. So half of it, you're actually making the payment this month. The other half, you're deferring it to the following month. Okay, so this is the same theory of the previous sales. We're collecting half of it, and we're deferring collection of half of it to the following month. Here, we're paying half of it exactly in this month. The other half of the accounts payable, we're deferring it to pay it out next month. Okay, so you'll be using the purchases amount that you got from the second table, slice it into half. Half of it you're paying out this month, the other half you're paying out next month. So who can tell me what is this? March, half of the purchases, half of the accounts payables from March. You transfer it and you pay it in April. Okay? So what are we getting out of this table is the summary of the payments that we're making each and every month, and also the aggregated amount. We'll be using this at the end also in statement of cash flows. So this is the second part of cash budget. And we have one last table here on operating expenses payment. So just like the previous two tables, a portion of some of the expenses we may be deferring to pay in next month. A portion we may be paying in this month. Okay, so the first two bullet points, the middle two bullet points here is basically a policy for salary and commissions payments in the business. So they assume that whatever salary expenses occurred in this month, they'll only be paying half of that in this month, half of that in next month. So if you refer to this table, let's say just the first line, commission expense. How much are we actually paying in April? Just commission expense. It will be half of $7,500, right? Because if we're paying half of them this month, the other half we're actually paying out by cash next month. For May, we'll be paying $6,000 this month, $6,000 in June. June's $9,000 commission, we're paying $4,500 this month, $4,500 next month. Same for July, half of $7,500 this month, half of $7,500 in August. Okay, so we'll be referring to the operating expenses that, again, we got an operating budget. Whatever the sales commission total amount is, half of them we're actually paying by cash in this month, so we copy half of the amount here up to the cash budget. And then for the other half, we're paying it this month. Now for miscellaneous expenses, the company assumes that all the minor expenses, they're paying it in full this month, so we just copy the whole thing to cash budget. So basically for each and every problem, you have to refer to specifically what's the policy for that business and use the percentages, apply it to cash budget to see which part you're actually paying, which part you're actually receiving. Okay, so for all the other fixed expenses besides salary, we're paying it in full in this month. So salary, again, salary and commissions, they're only paying half. So half of $2,500 is paid in this month. Half of $2,500 will be paid in next month. Okay, now rental expense, assuming that we're paying in full, just copy the same information to cash outflow. And then are you aware that some of the categories are not copied over to cash outflow? Which ones? Depreciation is not copied. Insurance expense is not copied to cash outflow. Why? Some of the fixed is copied over. What copies over means that there are actually companies paying out the money. Cash is being shifted out to somebody else, vendors, to staff, right? Why are we not copying over $500 for each and every month's depreciation over to cash outflow? What is depreciation expense? Remember that you got mostly the concept of it, because depreciation refers to long-term assets usage, right? And remember, it's a measurement. It's not really paying out this $500 to any vendors. Depreciation is just recognizing how we have been using expenses in accounting. So how we have been using the asset. We measure that the longer we use it, the lower value it has. So depreciation really is not any type of cash inflow or cash outflow. Right, we're not paying out any money. It's just a measurement in accounting that we estimate how long we have been using the asset. Okay, so every time when you look at income statement, when you see depreciation expense, remember that it will never be transferred to statement of cash flows because we're not paying out any money. We're just estimating that every single year assets grow old, $500, or every single month. Okay, so depreciation just omitted. We don't have to transfer this to any cash budget statements. Okay, now insurance expense. Insurance usually in the companies or for each and every one of us would be prepaid beforehand. Okay, so if it's a prepaid insurance, it's basically a type of asset. What you're doing here every single month to estimate just how much that portion of that prepaid insurance expires. So again, this $200, you already prepaid it before, we're not going to pay it again. So what insurance expense is just recognizing the portion of insurance that has expired. Remember, in financial accounting, we usually turn insurance expense, we debit it, and we credit prepaid insurance because we recognize that a portion of that prepayment has expired. So this is also not a cash outflow for later months. We're not really paying anything out because we readily paid this in full before. Okay, so whenever you see depreciation, whenever you see insurance, just exclude it. Look at all the other expenses accounts that we're actually paying by cash. Okay, so the upper cash flow budget for operating section, we're just including variable costs, sales portion, miscellaneous, fixed costs, salary, rental, and we exclude depreciation and insurance. Okay, so again, the blue highlighted numbers, later we'll be using it for our statement of cash flows for the entire cash budget when we combine these tables. Okay, let's take a look at a combined cash budget. So we just broke it down into cash collection. We talked about cash payments specifically on inventory purchases. We also talked about cash payments on operating expenses. This is a table that puts together everything. So you see the first section here, we start from cash balance. So cash balance, where does that come from? From previous month and also previous month specifically balance sheet, right? Cash is the first account in balance sheet. So you'll need to refer to March 31st balance sheet to get that $16,400. That's the first line of April. And then for May's, you basically get it from here. All right, for June's balance, you get it from here. For July's, you get it from June's. Okay? But the first month in April, you need to refer to March. Now the following cash collection line, the second line here, basically is the table that we just did earlier. Remember, some of the cash sales we're collecting this month, some of them defers to next month. So that summary blue line number there, we transfer it to that table. The last table, cash budget, puts together everything. So if you total up what you had in this month in the beginning, add in what you're newly collected in this month, that gives you the total available cash, the third line. So for April, it will be $62,400. Okay, so upper part is the cash collection part. Now the middle part here, cash payments, we use whatever the payment we made for purchases, for inventory purchases. Remember, half of it this month, half of it next month. The blue highlighted number, total payments, which transfers to cash budget. Operating expenses, we just did a pretty lengthy table there. Variable expenses, fixed expenses. Again, we transfer the summary amount into cash budget. Okay, so this table upper part really just combines what we just did in the first three tables. Now, what is that $3,000 right below that blue line there? Buy a delivery truck, okay? And this is a cash budget statement, so meaning that we actually paid out $3,000, right? So that part really refers to this. What we just covered earlier was just the operating expenses inventory part. This problem in the book, it also tells you that the company wants to expand their long-term assets. They decided to purchase delivery truck. After doing investment, they think it's worth it. It will provide additional value to their sales activities. So they use up $3,000 to purchase the truck, which is also included in this cash budget if it's paid by cash directly. Okay, so we just add additional line. If the problem tells you there's long-term assets purchased using cash directly, just add it to the cash budget. So that's the $3,000. After that $3,000, the middle portion here basically is the total cash payments that you did, which again is the delivery truck payment, operating expenses payment, inventory payment. Add them together. Becomes the $59,450. Okay, so label number 1 here, ending cash balance before financing. we're using whatever we paid subtracted from what we collected. So what we collected in April is $62,400 minus $59,450. You get the ending balance of cash, $2,950. Now it tells you additional information here, number 9, that the company wants to have every single month at least, they want to have cash balance on hand, $10,000. So usually companies will set a threshold for cash balance, just in case anything happens, if they have machine breaks down, if they have special orders. So perhaps they want to, different companies have a different threshold, but this particular one example, it tells you that we need to have at least $10,000 cash on hand. So based on this policy here, since the company in April, the cash fund runs a little bit low, it's only $2,950, they decide to borrow money instead. Okay, so this bottom portion here, the minus $10,000, we're comparing what we have, the cash we have, compare it against the threshold that the company set in place, $10,000, and see if we need to borrow money or not to have at least $10,000 cash on hand. Okay, so in April we actually don't have enough money. We don't have $10,000. We only have about $3,000. So we borrowed an additional $8,000. Okay, so think of this as a rainy day deposit. They want to have at least, or just like you and me, we may have a bank account that we want to have at least how much money. But usually for you and me, what we do is we need to earn money, right? For companies, they can decide to borrow money also. Right, so we want to have a rainy day deposit at least $10,000. To fulfill this, they want to borrow additional $8,000 to meet this policy. Okay, so after borrowing $8,000, now the total cash balance they have is $10,950. This portion here, they're paying back that $8,000 on a monthly basis. They break it down to 8 installments. Every single month they're paying $1,000. They're also paying interest on it. Okay, so the bottom portion of this cash budget, if the company did not borrow any money, you would not have this section here on financing. This only exists when the company do borrow money, and this is the portion that they borrow, the principal amount. This is the installments that they paid every single month. Okay, but in case the company does not finance any money from other short-term debts, long-term debts, the statement basically will stop on top over there under number 1, cash balance before financing. This tells you that the principal amount is $8,000, right? And it tells you that the interest rate is given to you, 12%. So basically, if you break it down to 12% is a yearly interest, then you divide it by 12 monthly basis, this is how much you're paying. And since you're paying $1,000 by installments in the first month, so second month the interest rolling will be less. Third month, lesser. Okay? Okay, so this chapter, the example given in the book is actually pretty good since it's a more complicated example. So if you go through the policy-wise, what's set in place in the business, financing issues, what happens after they borrow money, basically we're just boosting up cash balance. So if you understand these things, you basically have a pretty good concept of the entire master budget. Okay, so make sure over the break, try to go through this example in the book. And this is pretty much all about cash budget. Breaks down to 4 components: the part of the cash that you're collecting by sales, the part of the cash that you're paying for inventory, part of the cash that you're paying for operating expenses, and perhaps additionally you may have cash payment for delivery truck, for long-term assets. And if the company has a threshold for having or has a set in place balance that they want to have a certain amount of cash on hand every single month, you compare the cash amount what you have in each and every month, see if it meets that threshold. If it doesn't, like this example, company may decide to borrow money, but then later on, each and every month, they may need to be paying installments. They may need to pay installments and also interest on it. All right, exercise time. Let's try to do an example on cash budgets. We're continuing on that exercise problem that we just did. So whatever number you had in the previous 2 tables, it's still usable for this table here. Okay, so this first table on cash budgets, we want to get the total amount of cash from sales that we're collecting from customers. And it tells you this company has a policy that they usually collect half amount of the sales by cash this month. They're collecting 30% of the sale the next month, 18% 2 months later. Now they have additional information on 2% never collected, which means it's uncollectibles estimation. Okay, so in financial accounting, remember some of the accounts that perhaps you may not be able to collect after all at the end. So we may estimate a portion as uncollectible accounts. But this problem here, you can just disregard that. Basically, you just need to use the percentages for the first three. 50% of the sales, so you need to refer to sales budget. Sales revenue for January, 50% of it you're collecting this month, 30% defers to next month. Basically, what I crossed out credits because it's 30% of the entire sales revenue. So it's not just a credit portion, right? So basically, whatever sales revenue you got in the sales table, use that amount in full to times 30%. Let's do. Right, so this budgeted cash collections requires you to estimate the level of cash collections on sales for each and every month. And a portion of it comes from this month's sales, a portion of it comes from previous month, and then another portion comes from 2 months ago. Okay, so first of all, you need to know how much is the sales revenue for each and every month. So you have January, February from previous two tables, previous sales budget table. You have November sales given to you here, which is useful for January's 2 months ago's 18% of sales that you're collecting in this month. You also have December's $425,000. Okay, so to get January's cash sales, you would need to calculate 15% of current months, which is how much? $765,000, and then you get 30% of December's, which is $127,500. Then you have 18% of November's. Okay, so 18% of November's will be $72,000 for January. For February, same logic. You'll be collecting half of what is sold out this month, then 30% of what is sold out in January, 18% of what is sold out in December. Okay, so for these 2 months, you'll be using, again, 50% of whatever is sold out in this month, 30% of what is sold out in previous month, 18% of the sales revenue for 2 months ago. Then you add them up, that becomes the total cash collection you're making for January and also for February. Okay, so this is the first part of cash budget, the cash inflow, cash that we're collecting. Now the following table, let's do an exercise on payments of inventory purchases. Okay, next table here, budgeted cash payments for purchases. You need to refer to the previous cost of goods sold, inventory purchases table that you did in the previous page. So it tells you that we're paying half of what we purchased this month, and we're paying half of what we purchased from previous month. So basically, all the purchases you made in this month breaks down to 2 parts. A portion defers to next month. Okay, so just fill in this and figure out the total cash payments for inventory. So for December purchases, you have December sales, right? December sales, then how do you get the inventory that you purchases from December sales? So follow the same inventory policies in the previous to find out December's purchases. Right, the critical part of this table is the first box here, January's 50% of last month's payment. So last month's purchases comes from December's sales. Okay, so December sales is given to you in the previous table, $425,000. And remember, there was a policy of finding purchases. You start from getting cost of goods sold, and then ending inventory, there was a policy having at least $10,000 and half of January's cost of goods sold. If you add them up, the total inventory required, compare that against beginning inventory, which comes from basically December's expected cost of goods sold at $10,000 because this is November's ending inventory. Then you get December's purchases. Okay, so this table here, all the other boxes are pretty easy. You need to refer to operating expenses budgets to get to the purchases for January, purchases for February, and then half of it becomes this. Okay, what's critical here is December's purchases. If you're paying half of that, you need to figure out December's purchases first. Okay, so once again, December's purchases, we need to trace back to what is December's expected sales, which is given to you, $425,000. Then, second question is, based on the sales, what is the expected cost of goods sold? 60% of sales. So that will give you $255,000 is cost of goods sold. Then based on cost of goods sold, that's the portion of the inventory that you expect to sell out. Ending inventory is the portion that you expect to keep. So ending inventory, we already got it from previous tables, is $469,000. Remember, it's using January's cost of goods sold, half of that, plus $10,000. So then we calculate beginning inventory. So remember, beginning inventory for December would be basically November's ending inventory. Okay, November's ending inventory. November, it's also given to you what's November's ending inventory. You need to use December's cost of goods sold, again, times 50% plus $10,000. So once you have all these information, when you get purchases, you basically add cost of goods sold with ending inventory minus beginning inventory to get the purchases for December. Purchases. And once you get the purchases for December, then you divide it by 2 because we're only paying half of it in the following month. The other half, we readily paid it in December. Okay, so all the above calculations is referring to this number here. Well, that comes from this. So if you divide, this basically is 259,650, and this is 329,250. Remember that February we're paying 50% of January's purchase. So this is January's purchases times 50% gives you these two. And then February we're also paying 50% of our sales in this month. Right? So this is February sales, purchases, I'm sorry. Okay, so once again, this red highlighted number here refers to December's purchases, and we're paying half of it in January. So December's purchases, you need to use the same logic how we got all the other purchases in the operating budget. And the second table that we got, using the same policy to get to December's purchases. Since you're given sales, and we also got cost of goods sold based on January's, the 60% of sales. You can get this from the given sales. Ending inventory is based on January's cost of goods sold, right? And then you figure out beginning inventory based on December's itself's cost of goods sold. At the end, you can get to December's purchases, and then half of it you're paying in January. Okay, so all the above calculation basically is just referring to the previous table. You can try to add another column as December and fill in all these information.